All right, we're ready. Everyone good?
We're good.
All right. Hello, everyone, and welcome to the show. My name is Chris Alaimo.
And I'm Ben Gassaway. Together, we are the Amateur Investors.
This podcast is our open source journal of everything we learn about investing and wealth management.
We're here to explore the key concepts, market dynamics, and investing strategies that will assist you on the path toward financial independence and financial literacy. Our mission is to build us up from amateurs to experts.
All suggestions are our own, and we recommend that you do your own research before taking any investment advice. See you in this week's episode. We hope you enjoy it. Hey everyone, welcome back to another episode of the Amateur Investors. We have a special guest this week. We got Jim Davis from Mills Wealth Advisors. He specializes in working with ultra high net worth individuals. While Ben and I don't consider ourselves high net worth individuals yet, we hope to consider ourselves there one day. So Jim, we're looking forward to talking to you and giving us any advice that the ultra wealthy have or that they can bestow upon us going forward. Thanks for the show.
Thank you, Chris, for having me, and thank you, Ben, for having me as well. I'm excited to be here.
Yeah. So I guess we'll get right into it, Jim. So Ben and I, we typically specialize in helping people that are kind of, high debt, coming out of college, working with debt management and, kind of the accumulation phase of trying to build wealth, starting with your base salary and kind of putting up money aside for investing in assets, whether it's, stocks, bonds, I'm getting into real estate now. Cryptocurrencies, we can go over that a little bit later, but Bitcoin specifically. Yeah, Bitcoin only. So Jim, I guess take us through what's the best thing to do or what are some nuances that we can learn for starting off?
And maybe just a little bit about you. We'd love to hear about you, your firm, how you got started, and then let's dive into it.
Yeah, absolutely. So as we kind of talked about before the show, my background, I don't actually think we touched on this. So I started in this industry. Well, before I started in this industry, I was originally, when I was in college years ago, I was going to be, I went the psychology route. I wanted to be a psychologist and teach and do therapy on the side. And it was only until later in my undergrad that I did an internship at like a really great firm or agency. And I was absolutely miserable. And I realized really quickly, I'm about to graduate with a degree I can't do anything with. I love psychology as a field, but I didn't want to be a therapist, or I didn't want to be, an LPC or LMFT or anything like that. So I was fortunate to meet with an advisor who kind of talked through my story. And he's like, well, you need to consider like, what do you like about psych? And I said, well, I love working with people and I love working with numbers. And so he helped me connect with a grad program that really focused on like statistics and things like that. And it was kind of a consulting track, if you will. So I did that for a little while. And in the midst of that, I wasn't sure kind of where I wanted to end up. And it was that same advisor who said, listen to me I was fielding things of like, do I work for an Accenture or Boston Consulting Group? And kind of going the traditional MBA consultant route. But I knew with the young family and stuff that wasn't really going to be a good fit for me. So I met with his son in a small town called Sweetwater, Texas. And that was the first time in my life I'd ever heard about what a certified financial planner, or CFP, was. And it was the perfect intersection of psychology, meeting with people, but also statistics and keeping up with the markets. And so those roads kind of converged, and his advice and some other people's advice was to go work for a firm like a Fidelity or a Schwab or a big institution, get experience, working for several years at one of those firms, working with a large volume of clients so you can get a lot of good experiences. And then from there, maybe work where I'm at now, which is a smaller, more boutique firm. Along the way, I've worked at an ultra high net worth kind of family office in the Dallas area, which taught me a lot of valuable lessons. But I end up here today because I really love working with people, but I also like putting in my headphones and spending time in spreadsheets and kind of connecting the dots between those two things. So that's where I'm at right now. But to go back to your question, originally, like, what's the secret sauce? How to ultra high net worth manage their money, how to high net worth manage their money. It's pretty simple. It's lottery tickets. No, I'm just kidding. It's funny. The way my career progressed when I started in this industry, working at Fidelity, the way Fidelity kind of sets up their, how I say, their wealth services for people who are starting out becoming financial planners or wanting to be financial planners. They have you start off in kind of like entry level roles, and you work with people with certain dollars under management. And these are people who are, like you said, younger people starting off, getting started with investing, and then you kind of progress to like higher net worth. So as I started working with younger investors to call it medium-sized investors to retirees with sizable nest eggs, and along the way, I realized a lot of these people were asking the same kind of questions. And the people that, it's kind of like The Millionaire Next Door, the book you guys might have read.
Yeah.
The people who have become hyper affluent or become wealthy, I mean, unless they had a big liquidity event like selling a business, most millionaires become millionaires because it's a pretty simple formula. They spend less than they make, and they're not stupid with the rest. Like, I mean, that's whatever is left over. I mean, they invest it and they're smart with it, and they understand the effects of compound interest. So similar to high net worth people, working with people who are high net worth, a lot of them are, I mean, it's down to their habits and their behaviors, but it's not entirely rocket science. They live within their means, whatever that delta is between what they're spending and what they're making. They're saving and they're investing, and they're letting their money and their assets work for them. It just comes down to scale. You know, some people have more than others, but the underlying principles are really similar and the same. It's just a school teacher maybe is not able to do it at the same rate as an executive or something of that nature, but the laws and the underlying principles are relatively similar in my experience.
No, that's a really good analysis. I appreciate the background. And to your point about like the psychology, maybe not being able to do something with it, very clearly, I mean, you are. The formula is super simple. It's, spend less than you make, let it compound. But there's also that variable that really isn't broken out into that formula. It's human behavior. So I don't know if you've seen that commercial with Paul Giamatti, the Volkswagen commercial, with a client that has, questionable spending habits at best, gold toilet seats, jet packs out of their spare plane for their spare private plane, yachts for their yachts. When you're dealing with, ultra net worth individuals, or even really just someone who is building their nest egg, the concept of lifestyle creep. I'd love to understand sort of when folks come into massive amounts of liquidity, or even when they're just building that wealth, how do you maybe love to hear sort of like one of those types of client questions with the gold toilet seat, but also maybe how do you rein in that behavior and build some rigor around that management strategy? Because I feel like as the money grows, the looseness of your
more money, more problems. Is that what you're saying, Ben?
More money, more problems. I mean, that is law at this point.
Yeah.
So I'd love to hear your perspective on that, just to really mitigate the tendency of lifestyle creep as people grow their wealth.
I'm fortunate to mentor a lot of people who are starting in their careers now through like the CFP board and things like that. And I'm kind of biased because of my background. I think we all are, but I often joke that my job is much more psychology than investments. It's 80-20 or some crazy number in between. Like it's, so I tell people like, man, if I could go back, I would have done a similar thing. I would have got a psych background with maybe a minor in accounting or a double major in psych and accounting or finance, something in that vein, because you could be the best statistician in the world or CFA in the world or MBA in the world or analyst in some respect. But at the end of the day, I'm in the people business. I just happen to be dealing with money. Some people work in the investment world, but if they can't communicate that investment philosophy to clients to invest their money, then they're not going to be working for long. And so what I would say, to go back to like how to high net worth spend their money or things like that, and to kind of rein in that psychology, I think the difference between people who are, I wouldn't even say ultra high net worth, just the people who are high net worth, call it $1 million or more, and their liquid net worth, things of that nature, they really focus on things they can control, right? People who understand wealth and understand building wealth know they can't control the markets, right? But they can arbitrage taxes or capitalize on tax savings, right? They know they can take advantage of low interest rates or borrowing against their assets, things of that nature. So I think the people who are wealthy, it's the old adage, spend less than you make, invest the difference. But it's also, it's real basic truths, focus on what you can control, not what you can't control. I mean, be smart about it. Obviously that's our job, but really focusing there. To go to your second question, how do you help rein clients in who they spent too much? I think an easy one anyone can relate to. One of my clients I recently started working with last year, she became a single mom through a divorce and some situations, and she had never kind of had been the steward of her family's wealth. And so she gave her two daughters credit cards and said, hey, like, here's your budget. It's $500 a month or $400 a month of allowance and whatever the number was. And they were doubling that within like the first 2 weeks. They were just going way over. And she was like, how do I teach them to stop spending so much money? And I was like, well, you maybe sometimes you have to put controls in place that don't allow them to do that. So let's get rid of the credit cards and let's get debit cards. I mean, we're talking very elementary stuff. And let your daughters know, hey, when this thing bounces or when it declines, like, that's it until the first of the next month or whatever. And so we curbed that behavior, I think, within 2 months because I think she ran out of money and she needed gas money like week 2 or whatever in the month. And I think Shannon, my client, she said, okay, I'll give you some money, but it's going to come out of next month. So I'm going to give you an advance, if you will. So that was kind of a funny way that I thought was a helpful way to kind of curb spending behaviors. You put some controls in place. But you know, I think when you going back to psychology, I'm going to do that multiple times probably on this call. My job is not to tell clients how to spend their money or their wealth. Like, that's not my job. It's not my job to tell them what they should or shouldn't do or how they should or shouldn't enjoy their money. My job, kind of like a sports coach, is to say, hey, like, my job is to help you get from where you are today to where you want to be tomorrow with the resources you have now and along the way, right? Savings rates, spending rates, things like that. If you want to get to the top of this mountaintop that you've set for yourself or your family has set for themselves, or multiple goals or multiple mountaintops, my job is just to kind of help you stay accountable, right? And so when you frame things like spending or excess spending, or, you know, like you said, more money, more problems, when you frame it as like a, hey, stop spending, they're going to keep spending. But if you can reorient your clients to thinking about things like opportunity cost, or compound interest, both in a good and a bad way. Everyone understands compound interest, right? Let your money grow, let it work for you. But it also works in a negative light as well. You know, it grows the opposite way. It can compound negatively if you're spending at an increasing rate. And so helping clients think about, I'll give you an example. I was talking with a client recently about using an HSA account or a health savings account. And he wanted to pull money out of his HSA to do a dental procedure. It was like $500. And I told the client, I said, listen, you can take that money out, but I know you got the money in your checking and savings. You can pay that out of pocket with no issue. I was like, but you got to realize a $500 withdrawal from this HSA, which is an amazing savings vehicle. If you guys haven't read about them enough, in 7 years, that could be $1,000, tooth procedure, tooth operation, or a $2,000 procedure in 20 years because of compounding, right? And so reframing spending habits and like not what it is today, but what it could cost you down the road, I think has been more helpful than anything else for clients, at least in my experience.
Definitely. And I love your analogy when you said, like, you're in the business of people. I know Andy Reid, he's a football coach of the Kansas City Chiefs. And before their recent Super Bowl, not last year, obviously they lost, but the year before, he was telling all his players, basically, like, you guys aren't in the football business. You guys are in the people business. If we hope that we can keep all our players, but every year, everyone's job's up on the chopping blocks. Maybe not Patrick Mahomes because they just gave him $480 million or $440 million, but you get the point that, like, yeah, exactly that. But like pretty much everyone's jobs are on the line. And if, you're a good person and the team doesn't have the need for you, if you're a jerk to them, they have no incentive to reach out to the other 31 teams and be like, get a good reference of like, hey, he doesn't fit our squad. Like, we've got younger people coming in or for whatever reason, but like he would be a valuable asset to any one of the 31 other teams. And he just goes to show that's just in football. And he then goes on to say, he's like, I don't want to scare anyone, but all of you guys are going to end up retiring from football one way or the other. This game, it's a game against time. I despise Tom Brady because being a Jets fan, but we don't have to get into that. But if you're aside from Tom Brady and his fight against Father Time, everyone else has a career end date. And some come earlier than others due to injuries or other unrelated things. But, you're going to have a career after a career in football for the most cases. And I know me personally, we didn't talk about this before, but I think my long-term goal is to work kind of like what you do with high net worth individuals. I love sports, so I'd love to work with, athletes and be like, hey, like, you're making all this money now, but let's not blow it, in the front end and be able to preserve this. And like, this is generational money, and make this last not just for you and your kids, but your kids and your kids' kids and your great grandkids. You know, when you're making all this money, let's not waste it. And I hate the stories of these professional athletes who made quite literally millions, probably, I'll be honest, more than I will probably ever make, but then, you know, end up in 5, 10, 15 years or even shorter, you know, having to sell their championship rings or memorabilia just to stay afloat because they spent all their money. So I would love to be in a situation to help people and assist them with that, basically wealth preservation.
Yeah. And you're right. I mean, it's, it really comes down to values, you know, but you know, like, what do you value? What do you want this money to do? What do you want this? One of my favorite planners I read and follow, he talks to his clients about what story is your money going to tell? Because money, whether you got $1 million or $1,000, it's a tool. It's just stuff, you know, like, I mean, everyone loves the adage and knows the adage. No one wants to die with a pile of gold in their coffin, right? Like,
yeah.
You know, everyone knows that, but their actions reflect that, right? Like, and I'm not trying to say be, you know, a vagabond or totally into minimalism or things like that. But if you understand, and not to even get spiritual, like money is not your God kind of thing, right? But like, if money is a tool, no different than a hammer or a screwdriver, right? It can do great things. It can do horrible things. The internet is a great tool. It can teach you so many things, and it can be used for horrible things. And so to make money the scapegoat of evil, like some people who, you know, they damn the wealth or they damn the ultra high net worth, money is not the issue, right? You could take a Bill and Melinda Gates Foundation. They wouldn't be able to eradicate illnesses or diseases if it weren't for their significant wealth, right? So I think with clients, especially like athletes or people, business owners, like I've worked with a lot of people who've sold a business at a young age and they just had this windfall of cash and they get paralyzed. What do I want to do with it? It's a good problem to have, right? But ultimately, I think a good planner, to take a line from like Carl Richards or something, is to say, listen, your money is a blank canvas, like, or a set of paints or pastels. What image do you want to paint? What story do you want to tell? Right. And so with someone who comes into a windfall of cash, or someone who's even older and saved their money, maybe the story what they want to tell is a legacy for their kids and their grandkids. And that maybe leads you down the road of doing things like philanthropy with your money, or setting up a donor advised fund or foundation. Other people want to set up, you know, intergenerational wealth. They put money into their estate to go down to their kids and grandkids and so on and so forth. And I don't think there's a right way and a wrong way to do it. But I think it's important to know that dying with a bunch of money it's not going to be a lot of fun. But if you can somehow find a way to align your money with your values and tell a story with your resources, you're going to lead a much more fulfilled life, you know, than spending it on, like you said, rings and cars and things like that. You might have a fun life. I'm not saying that. One guy I follow, he said, money doesn't buy happiness, but it buys jet skis. And no one's ever been mad. No one's ever been upset riding a jet ski. So maybe my answer is somewhere in the middle, not to get too heavy.
I like that. I think that was a really great point. And you know, a previous guest, Jim Kreider, even mentioned that when you're talking about money, you need to talk about your values and your principles drive that. So like, let's say you want a house, let's say you're building a house and you have a toolbox. If all you ever do is grab the hammer, you know, buy the Porsche, everything's a nail. You forget to build the house. So I like these like sort of analogies about sort of like, what are you trying to build? The money is only as useful as it is spent, because at the end of the day, you can grow your net worth. You can give it off to a relative. That's a pseudo spend, but the money is only as valuable as it's spent. It's a means to an end.
Exactly.
So I'd love to hear, and you mentioned it, about sort of anchoring folks back to what is important to them, that time preference. What are you trying to step towards? I'd love to hear maybe a few strategies that you employ for clients to maybe anchor them and help them frame that mindset, and maybe something that even us folks in, you know, middle class or really just agnostic of any sort of like class structure, that folks can really think about to try to frame those values, frame those next steps. What are the strategies that have helped really click with clients?
Yeah, that's a great question. I think it's important to understand, like, as a financial professional, as a financial planner, a steward of someone's wealth. I think it's really important to understand like the role you play in the story, right? I think a lot of advisors want to be, to steal a line from Donald Miller's story brand. Like, a lot of people want to be the hero in their client story. I'm the Luke Skywalker who's, you know, taking my client from here to here. But the reality is you want to be in the background as a planner. If you're doing your job well, you're not the hero of the story. The client's the hero of their own story. They created the wealth. You're just helping them steward it, right? So I think the best posture to have as a financial planner, and the more, like I alluded to before the show started, the more I learn, the less I know, kind of thing. The best thing an advisor can do is just shut up and listen. Like, let clients tell their stories. A lot of advisors, they have a tendency to want to shepherd a client in a certain direction. Like, like, I'm going to ask you questions, but my underlying agenda is to get you from here to here. Right. And we do this all the time. We might be doing it right now with this podcast. Like, as I'm speaking or as you're speaking, I'm thinking, okay, what's the next question? Like, where can I redirect this podcast, or where can I redirect this conversation I'm having with this client to get to my next agenda item? But what if we just stopped and, almost in a Buddhist sense, just were present in the moment and actually listen to what our clients were saying, not hearing them, but truly listening to them. And oftentimes I feel like if you step back and you get out of the way and let clients tell their own stories, the planning part becomes easy, because they're going to tell you what they're most passionate about or what's most valuable to them. I think a great technique is a guy named George Kinder. I don't know if Jim Crider alluded to this or not in his call. Him and I are both a big fan of his work, but I'm going to botch this, but Kinder has this technique where he asks clients 3 questions. Essentially, you find out one day you go to a physician or a doctor and you've got a terminal illness, and you've got, I think let's call it 1 year to live. Now, you're not going to be in pain, you're not going to be suffering, but you got 1 year to enjoy it, and then it's gone, right? What are you going to do with your year? Okay, so that forces the client, or you, maybe in this moment, to kind of think about, okay, if I have a year left, no pain and suffering, what am I going to do? Fast forward, you go to your next appointment and you got 3 months to live, whatever it is. It's a shorter time frame. Same thing. Hey, sorry, I botched it. We don't have 12 months. We got 3 months or whatever it is. Like, what are you going to do with your 3 months? And then he takes it a step further. And by the time you get to the third question, it's, okay, you got a week to live, or you got a month to live, a much shorter window. What are you going to do with that small amount of time? And when you force yourself to really chew on those 3 questions, it forces you to realize what you value most. Most people in that situation want to spend time with their loved ones. They want to spend time with their kids, their friends and family. They want to travel. They want to have experiences in life. And so asking clients point blank, what are your goals? It's just a crap way to do it. But if you ask clients to think about what's most important to them, tell me your story. And when you ask a client to kind of tell their story, they'll talk about their kids, they'll talk about things. And so I think the best thing for an advisor to do is just listen and camp out on the words they say. Listen for clues, like feeling words. I'm scared about this, or I'm excited about this. What makes you excited? So good questioning, better listening. I've heard the expression, like, you got 2 ears and 1 mouth for a reason, right? Do one twice as much as the other. So that'd be my advice. And that's a recommendation I have for clients to kind of think about, is to sit down with your spouse or yourself, if you're single, your friends or your loved ones, and write down, like, let's say I've got 1 year, 3 months, 1 week to live. What am I going to do? And that's going to force you to really think about, like, what do I really value? And so once you figure out what you value the most, how do you reorient all your resources to align with those values? So if you find out what's most important to you is spending time with your family, maybe don't go work for Boston Consulting Group or Accenture. Maybe work for a local small firm. You're going to get paid as half as much, but you're never going to miss your kids' soccer games. I mean, that's my experience. Like, and so I chose to go this route versus the other. I knew I'd make a lot more money doing one versus the other, but I personally value my wife and spending time with my boys more than anything else. Now, I'm a terrible soccer coach. I think we've won 1 game this season, but I truly value that time more than any dollar or investment I've ever made in my brokerage accounts. And so I'd say that's a good place to start for clients, is to really sit and chew on, okay, if let's say I've got a month or a week and I've got a terminal illness, what am I going to do with my time left? And that's going to force you to kind of think about, what do I value the most? What do I want to spend my time doing? And how do my resources reflect those values? And maybe they don't, and that's okay. But maybe you can put yourself in a position where they do at some point in time. That's my 2 cents on it.
No, honestly, I pulled a lot of good nuggets out of the things that you said. One is, when you're selecting a wealth advisor, make sure they listen to you more than they talk to you, I guess is what I'm hearing.
Yeah.
And I like what you said about, you have 1 year to live. And I feel like people maybe think that's cliche, but I think the framework of truly conceptualizing that is actually a difficult skill, to be quite honest. Like when you truly are able to perceive that limited amount of time, that urgency, that really does force your hand to make those decisions, because, you know, you always hear stories of like elderly folks on their deathbed saying, I wish I did this. I wish I spent more time with my kids. I wish I did this. There's always that latent regret retroactively. So if you think about it now and you kind of have this ever present mindset of, I want no regrets in the future. So do I need that Lamborghini, that house in Aspen? Maybe not. And maybe you do. Maybe you do want, and that's fine.
And
There's nothing wrong with that.
It's not damning those things. It's just understanding
Correct.
what gives you fulfillment. And some people love adventure and experiences. And yeah, Ferrari, if you got a balance sheet that can afford it, buy the Ferrari. Like, you know, you're not going to die with one. So like, you might as well have fun with it. I totally agree with that statement.
Yeah.
And I guess
I think
that'd be buried in one, but that, you know,
hopefully I'll have a Ferrari one day. But I think that's the point, is really sort of like understand what are your drivers. And your point about the client that had given out 2 credit cards to their daughters, right? Recognizing that there are flexibilities in a financial plan, that it's not just one size fits all. The simplest solution is likely going to be the most elegant solution. Just switch it to a debit card and you fix the problem. So listening to your clients, understanding, I guess, yourself as the client, and then understanding those levers, I think, is what drives a really strong financial plan. Once you've kind of maybe developed those values, the foundation of what makes the client tick and where are we trying to get to, I'd love to hear, and I don't know if that's like a price elasticity graph you have on the whiteboard, but I'd love to know maybe some of like the most challenging problems that you face in sort of the custodial end of things, where you're working, you know, you've figured out the values, you understand the client, the next steps, maybe a challenge that you face regularly if there's recurring themes. But I'd love to hear like a challenge that you've struggled with and maybe that you've learned a lot from.
No, that's a good question. Cause I mean, I love, as this conversation will allude to, I love the soft stuff. I love the cheesy like conversations. My job is to, after those conversations, go and back test it against data and Monte Carlos and things like that. That's why you see stuff on the board, right? But clients don't like that stuff, right? The clients don't like to know. Advisors, I think, to justify their own egos, would like to tell how the sausage is made, you know, to prove our worth and how we work hard. But at the end of the day, I think the clients just want a good product, right? And I like to call it a tension of opposites. Like you want to give them information to establish credibility that you're doing your job and you are working and you're not completely behind the scenes being passive, right? You are actively monitoring their investments and things of that nature. But on the flip side, you don't want to be drowning them with information, right? So I think that's a challenge, is constantly kind of finding out, like, and every client's different. So like, I would say that to answer that question, I'm going to give you a political answer. It depends on the client, right? I have some of my clients, Mike, for example, he's a client of mine. He loves to actively trade. He's always texting me and messaging me about this new stock or this new penny stock, and most of them are worthless, right? But he's very active in his portfolio, and I love that because he's super engaged. One of my clients, Greg, who I love to death, after working together for a couple months, normally when I bring on a new client, I like to meet with them about 90 days in or so and say, hey, we've done a lot of heavy lifting, got a lot of work done, got your accounts transferred over or rebalanced, or kind of got our ducks in a row. What cadence would you like going forward? Some clients like to meet frequently, some less frequently, and vice versa. And Greg told me, he's like, Jim, I'm a delegator. Like, he's like, you call me if you need me, but like, if we need to meet once a year, like that's plenty. Like, I mean, he is the most hands-off person ever. So, you have Mike, like I alluded to, wants to know how the sausage is made. Greg just wants to know, hey, money's hit my checking account once a month to supplement my retirement. Like, and the answer is probably somewhere in between. So I think it's important to establish credibility with your clients. But I would argue that the best way to establish credibility with clients is not by providing them technical solutions, but asking great questions. Really challenging your clients to rethink wealth in a non-traditional sense, you know, making them think about it as a hammer or a screwdriver or something like that to build a legacy versus like just getting into the underlying performance. I mean, we can do that. That's important if needed, but primarily your job is to make clients feel that they're going to be okay. I mean, at the end of the day, my job and like you said, Jim Kreider's job and some of these other advisors' jobs. Our job is to help simplify things that are complex. Fidelity, where I used to work, had this old adage that if you want to get someone to, what are 3 questions to ask? Like if you should manage money yourself, like be a DIY investor, or you should outsource and delegate it to someone else. And the 3-prong approach, and it's not the perfect method, but I really liked it, was do you have the will, do you have the skill, and do you have the time to manage it? Do you have the will? Do you want to manage your own wealth? If you do, great. Do you have the skill? Do you have the acumen to do so? You might or might not. And do you have the time? If you can't if you can't check the box on all 3 of those, then you need to be using a professional, someone to delegate that stuff to. Because let's just play with it a little bit. If you have the will, you want to do it, and you're smart enough to do it, you got the skill, but let's say you work a 50-hour week job or a 50-hour week job, and you don't have the wherewithal or the time in your professional career to be kind of monitoring and tweaking and making changes to your portfolio, then it might not be a good fit for you, and vice versa. You may want to do it, you may have the time to do it, but you may be terrible at it. And that's where, I always liked kind of that 3-prong approach. Do you have the will, skill, or time to manage your money? So I'm going to steal that from an old company I used to work at, Fidelity, but I think that's the best way I'd kind of relate to clients.
No, I like that. I think the skill piece is obviously very important, but I've been reading the 4-Hour Work Week by Tim Ferriss.
Yeah.
And he really talks about just outsourcing everything that you possibly can, that where it makes sense, and just unlock your time. So, if the time,
because time is a resource. All money does is buy you time. I mean,
it's one of the most scarce resources in our human lives, next to Bitcoin. But so talking about a professional, if you can't check yes on that time box, you've got to invest in a professional. It's not really an expense. It's an investment. So yeah, I really like that.
That's a good point, Ben. I'm going to steal that.
That's fine. You can get it before it's patent pending, so no worries.
It's not trademarked quite yet.
So Ben actually brought it up, which I'm glad. So Ben and I are really big into Bitcoin. I know we just kind of see, and this is not to scare anyone, this is just kind of us looking at the broad markets and everything that's going on with money printing and QE or potentially UBI or whatever you want to call it, or these stimulus checks. We see Bitcoin as kind of a hedge, as I don't want to say everything collapsed, but it's kind of that. On top of that, we kind of see it as a great investment. I know there's been a lot of fear, uncertainty, and doubt going on just this last 24 hours. We're recording on May 13th. Elon saying that it's, not environmentally friendly, or, but he didn't sell any. So it's like, well, you obviously don't think it's that bad that you're holding on to it. You probably want to buy more, but I won't mix his
I think he's going to make
motives.
his own mining company. That's what I expect.
Honestly. Yeah, exactly. Or he's buying more on the dip like everyone else when it went down. That's for the SEC to determine. So I'll let them do their own investigation or make their own determination. But I guess, how do you see Bitcoin as an asset class for young people like us, or even high ultra net worth people, that it's like, if you have a lot of money, but you want to hedge against potentially losing that in a market collapse, or, if you're young and you're starting off, like maybe this is a small portion of the pie, aside from also investing in stocks, bonds, real estate, or whatever you want to invest in.
Yeah, our clients' portfolios are 100. No, I'm just kidding. No, I do have. I don't mind telling you guys, I do have Bitcoin as a part of my portfolio. To give you the political financial advisor answer, because it fits in line with my wife and I's kind of goals, right? Mm-hmm. In a world where we print money freely, I think it could be a good hedge. That's why they call it digital gold. And not to get too technical, there's a lot of features. There's a reason they call it digital gold. It's finite. It's divisible. There's a million ways to defend. It's
more portable than gold too. Yeah.
Sure. Yeah. Like I'm pro Bitcoin. We have Bitcoin for the clients who want Bitcoin in their portfolios. It's definitely something it's harder for the institutional investors, like in my world, to do it for our clients. Gemini, I think, is coming out with some solutions. There's different firms that are coming out with solutions, but it's not as easy as having money. Like, we custody our money as a firm. This is kind of getting into the, like, how RAs or investment advisors do business, but we custody our clients' money at places like Schwab and Fidelity and TD Ameritrade, things like that. You can't buy Bitcoin at Schwab, Fidelity, TD Ameritrade, right? And so from an institutional level, it is tricky. Like, it's an operational issue right now. Like, how do we get more clients into it? So we're having them go through BlockFi and things of that nature if they want to add it direct to their portfolios. Some people who want exposure in their IRA accounts, like, we don't like the fee, but GBTC is an alternative solution to have as a placeholder until ETFs become available. But what I would caution anyone of saying is, so this is coming from someone who's pro Bitcoin, right? Um, if it feels too good to be true, if it's the end all be all solution, I never want to believe that one investment is going to make or break everything, right? Or like be this revolutionary thing, right? I really do believe it could revolutionize capital markets to a certain degree, having Bitcoin. But the best analogy I've heard for this, and if you haven't noticed already, I'm not smart enough to have, really technical answers. So I rely on analogies a lot to help kind of illustrate things. But
I do the same.
I think the best portfolios are globally diversified, boring portfolios. I like things that zig when other things zag, right? I think Bitcoin, like gold, like other commodities, like emerging markets, like international markets, I like my portfolio to always be losing in some regard, because that means it's diversified. If everything in your portfolio is going up simultaneously, you're not diversified, right? You may think you are, but the stats would show that if everything is correlated going up, then it's going to all go down at the same time too, right? So I think Bitcoin is a great asset to have in a portfolio at an amount that you feel comfortable with. So personally, I think at this stage in the game, for a lot of people, it should be maybe a small holding, maybe a 1, 2, 3, 4% holding, 5% holding. And for some people, it may need to be a 20% holding, right? Because that kind of lines up with their goals. The hard part of Bitcoin is forecasting, right? Like, it's such a new investment. A lot of people, and this, it's going to hit 100,000, it'll hit 500,000. And if you say anything negative about either of those prices, you're a bear or whatever on Twitter, they give you hell for, right? So I would say that I do like it as an asset class. I think it's important to have it in your asset class. But what I'd say is this: if I give any of you a pen right now, or pencil, I'm sorry, and I ask you to break it with your hands, you're going to do so with no issue whatsoever. And give you 2, right? And you'll break them pretty easily. But the second I give you 10 or 12 or 20 pencils, and I ask you to break them in your hands simultaneously, it's going to be really hard to do, right? I think our portfolio should be just like that. I think they should be so diversified that they can't be broken as easily as one investment, right? And so there's an old rule of thumb: never have more than 5% of your portfolio if you can. Now, some people, they work for companies where that's just not an option. They have stock in companies, or they're business owners where a large portion of their net worth is tied up in one security, and I get that. But if you can avoid it, not having all your eggs in a basket, as an old adage would say, is probably good. But to have 5% or something into an asset class you truly have conviction on, I don't think that's a bad play, as long as it kind of lines up with your goals. Like,
Yeah.
And especially in a world where we're just printing money as freely as we are, like, it's something that's definitely attractive. But
Yeah, and
we're down below 50,000 today, so who
yeah,
knows?
I saw it as an opportunity personally. I bought the dip, if people were wondering. But yeah, no, I think that's a great point. I guess the thing that makes it difficult is we kind of have, and I don't want to say, I said this on Twitter, I was like, the United States has financial cancer. And I think that's not anyone's fault or any one institution's fault. I think it's kind of a collection of multiple things. And that's part of the reason Ben and I started this podcast. But, we don't teach money in schools. And, maybe the one semester of health in high school where you have to do like, okay, you're going to do a little budget, you're going to pay taxes or whatever. And, it's very niche and it's once, but when you're really learning about money and investing and all this, it's a lifetime skill. That's why there's, money managers still now when there was 100 years ago. That's why, that we still have banks or institutions. And it's a real shame that we don't teach people about money and how to preserve capital and how to spend below your means. And, as much of it is psychologically, some of it is, the nuance or the mental aspect of it, or just learning about it. And
so I volunteer with a nonprofit. This is a plug here for this nonprofit, but Junior Achievement, I am absolutely convinced what they do is just amazing. They teach financial literacy to like elementary, middle, and public school systems. So you go and you teach entrepreneurship, financial literacy, things like that. And one thing I tell them is true wealth, and I've worked with thousands of millionaires in my career. It's not picking and choosing stocks. Now I'm not saying you can't, and people can make their wealth doing so, but the vast majority of millionaires, they do it by their behaviors more so than their investments, right? They systematically save. They're working and they're putting money in their 401k every month, or their brokerage accounts, or their whatever accounts. It's dollar cost averaging as long and frequently as you can. It's not about stock picking. It's about having the right behaviors in place. And so Bitcoin, if that's one of the asset classes that fall into your basket portfolio, is great. But like, I mean, Bitcoin, to get real specific on Bitcoin, like we have some clients, we think it's a good trade. Just being honest, like a small percentage of a portfolio, we think it's a good trade for most clients. But I have some clients who said, Jim, I don't want any part of it. And I said, you know what? That's the right call. Like, it's not my job, right? Like you should never force an investment on someone, because at the end of the day, like, investments are a lot like golf clubs. Like there's good Callaways, there's good Titleist golf clubs. Golf clubs are important, and you want to have a good quality golf. And this is for people who golf or at least watch golf to some degree. But I would argue, like, would you rather, I guess I would pose the question, would you rather have the best golf clubs in the world or the best swing in the world? Right?
Yeah, well, I don't have the best golf clubs and I don't have the best swing, so I'll
Right.
definitely take the swing to get
Because
better at my game.
we all know, like, you could have the best Callaways or Titleist clubs in the world. Jordan Spieth can go to Walmart, get a cheap pair of clubs, and kick your ass up and down the course all day long, right?
Exactly.
The clubs are important. I'm not saying they're not, but you can interchange clubs. So you can switch between a BlackRock and a Vanguard. That's cool, like picking and choosing the right things. What's most important is you have the right swing. And so I'd equate that to your financial behaviors. Like, are you spending less than you make? I mean, we're going back to what we said at the very beginning. Like, what are your behaviors, right? And good products will complement those behaviors. Like, yeah, don't buy 2% expense ratio mutual funds. That's a no-brainer. But you can have the best, you can have average products in great form, great stroke, great financial behaviors and disciplines. And you're going to outperform the guy all day long who's, splicing two different ETFs because one has a 3 basis point lower expense ratio. Like, who cares? Like, you're going to waste your time running circles around that dance. So I'd say, like, same with Bitcoin. Like, Bitcoin's great, but I'd rather have a client any day of the week who has a 20% savings rate than is picking and choosing the right crypto stock any day of the week.
No, it's a great point. And, like, disclaimer, I think Chris and I regurgitate this quite a bit, is that we have a pretty high conviction rate, and our allocation to Bitcoin is fairly substantial. It varies between us, but at the end of the day
too, probably.
Yeah, it does. But at the end of the day, like, for me personally, Bitcoin is a part of my investment strategy. I continue to dollar cost average into my various accounts. I have more than I probably would like, but I manage them and it's doing fine. But fundamentally, what you're saying is the values, the principles, the mental frameworks, those remain the same. The assets just change over time. And I think you need to do what makes sense for you, right size the position for what makes sense for you, even if it's a 50% position towards something, which is always risky. I mean, putting your eggs into a basket is, you need to bear the risk. And as an investor, as sort of the person with full autonomy over my finances, you need to recognize that you take full responsibility for that risk. But the suggestion to build an investment strategy, stick to that framework, follow the strategy, and know your tendencies, build your own guide rails. I feel like that builds wealth over time. It's not getting emotional, making sort of like the knee-jerk mistakes. You need to understand yourself. And as a wealth advisor, you need to understand your clients as well.
Yeah,
so.
And it's a great point. I meant to touch on this earlier. Not comparing yourself to the guy next door. Like, the worst enemy to investors is the guy in the cubicle, or the guy in the or girl, right? The person at their workplace at lunch talking about the next, GameStop stock. Like, I have one client, for example. He's been a great saver his whole career. He's made good money and he saved. He is, for what he needs in retirement, way ahead of his goals. So we've trimmed his portfolio down substantially. Like, his risk cost went way down. He's in a very balanced, moderate portfolio. And we were talking recently, he's like, guys, like, I want to be making X. The S&P did this, my portfolio did this. And I was like, well, what is this money used for? You want to do this in retirement, right? Yeah, I want to do this. You want to spend this on your kids, right? You want to leave this much to your kids. Like, we have the money now. Like, why risk it? Like, I mean, you can if you want to, but, like, you're comparing apples and oranges. And if you want to horse jockey your portfolio against the S&P 500, great. But my job is to help you accomplish your goals. I don't need an 8% rate of return for you anymore. I just need 4. Like, I just need 4 or 5. Like, because we now have the money to essentially accomplish all the goals you want to accomplish. Like, if you want to make money, great. But, like, you told me you wanted to do X, Y, and Z, and your goals were X, Y, and Z. We now have the resource to do so. So, like, why put him at an increased risk to potentially lose a good chunk of change, right? When the money is designed to accomplish goals, right? We now have the money to do so. If you need, and let's say you need to increase your risk because risk and return are correlated. If you need to increase your risk in your portfolio to increase your, your returns over time to potentially accomplish your goals, great. But, like, the portfolio has to complement what you want to do with it, versus, like, making your lifestyle fit your portfolio returns, which is like, I mean, you're just gonna be chasing that. Your lifestyle is just gonna constantly fluctuate, and that's just a bad place to be in.
Yeah, and definitely, I know. I'm glad you said that, and I know even on the risk reward curve, like you said, the further out risk you have, the higher reward in theory. But you're not including the risk in that. And once you get to a certain amount of wealth, I've even heard this. I mean, they always talk about the diversified portfolios, but it's like exactly like you were saying. You don't want all your eggs in one basket. Like there's a way to build wealth, and you could do it very risky. But once you get to a certain point, if you were to make $1 billion, like if I were to give you $1 billion, but you have to be diversified versus just being one asset class, that's probably your best bet, because you're going to preserve that $1 billion over time, instead of being like, if it's Dogecoin and it's like, this is either going to $1 billion, like $10 billion, or it's going to zero. You don't want to be in that example. And that's just, one example of it.
Yeah. No, that's a great point. Yeah. It's, what is the goal for this money? For retirees, oftentimes clients who are in that phase of life, my job is to sustain their wealth. They've spent their whole career making it. They don't need Bitcoin. I mean, they already have their wealth, right? My job is just to sustain it. If they want to have it, great. We'll sprinkle it in. It's fun, but they don't need it, right? For clients who are young and they have a long-term runway or a long time horizon, we need to get X in so many years. And we think inflation is just going to stay what it is and bonds are paying, pennies on the dollar. Like, yeah, we probably need to add some of that in your portfolio to get you the yield that you're looking for. I think I always go back to, does the portfolio match your values and your goals? And if you can say that with conviction, then awesome. You know what I mean?
Yeah. It's a race against yourself, honestly.
Yeah.
So Jim, this has been a fantastic conversation. It's been a lot of fun. But I think we're probably going to start getting wrapped up. One question I always like to ask our guests is, what has been the biggest investment mistake of your career? And, because you are in the financial services, you can also take the flip side. What has been the biggest, I guess, advisory mistake that you've made looking back on? You're like, wow, I wish I didn't do that. You pick.
Yeah.
Whichever one you want to talk about.
I give this story quite a bit on market timing. So when I'd been in the industry for a couple of years, when Trump and Hillary were going neck and neck for the election, and all the smartest people in the world said, if Trump gets elected, the markets are going to crash, right? They're going to tank. And everyone on Bloomberg and MSNBC, all the people that we love and trust, right? Said if Trump gets elected, the market's going to crash. So when I was watching, when it became a reality that Trump was going to win the election, I'm talking like election night, I think it was election night. The next morning, I was a brilliant wizard with my investments, and I went to cash. I sold everything. I was like, you know what? I'm going to market time, and I'm not going to, how it ended up. The market went on a freaking tear. Well, I obviously mistimed that one. That was terrible. What I forgot was to trade my wife's accounts. So my wife has some Roth IRAs and things like that. And when I went to cash across the board on everything, I forgot to touch her accounts, which are pretty much broad-based indexes, almost 100% equities. And she got to enjoy the entire run up in the market. Meanwhile, I'm sitting here in cash like an idiot. And I do this for a living. She's a nurse. So just to give some context. And to this day, she still jokes, because her net annualized return, our portfolios are now the same. Like, her net annualized return is still better than mine. So she often jokes, because of that mistake that I made. She's like, listen, whenever it comes to investing, she's like, well, I mean, who's got better returns, honey? And my wife, unless something dramatically changes, well, our portfolios are the same, so I guess it won't. She's always going to have a better annualized return than I will. And so that's a lesson that was hard learned on market timing that she still gives me hell for to this day.
Hilarious. It's sort of a personal case study on timing the market is better than timing the market. It's brutal. Losing money is a painful teacher, but it teaches.
I tell clients all the time, the best way to learn in this industry is to lose some money in it. That's a painful one.
That's a great one. I mean, so I've gotten to the point where I'm very boring. A lot of my stuff set up like Bitcoin dollar cost averages every day. It's like $10. I dollar cost average my 401k, Roth IRA, have excess money, HSA that I'm putting into. So, but then it's part of what we do on this podcast. Ben and I like to look at stocks and all types of investments, and just, it's kind of like my fun money. If it were to go to zero, would I be bummed?
I think that's awesome, by the way. I think having a lion's share of your money in boring, simple stuff, it's like vanilla ice cream. It never goes bad. Just, it does what it does. It never disappoints. Now, no one's ever going to be jazzed up about vanilla ice cream, but no one's ever disappointed in it. But then to have something on the side to play with, I don't think there's anything wrong with that.
Yeah, exactly. And it's like, I mean, I guess I'm a good example of that. I live below my means. I have money. I don't neglect my girlfriend that we never go out to dinner. I take her out to dinner. We do fun things.
When
And then
you go to Chipotle, do you get guac or do you not get guac?
I get guac,
Oh, there you go. See, now
Lavish.
The Bitcoiners are going to hate
living
me
lavish,
for that one.
Now we
The
pay for
Bitcoiners are
some
going to
tea
hate
on
me.
the
They're like,
side.
how much is it going to be worth one day?
Yeah.
No, but like I said, I have a good balance in my life. I'm not hurting for money. Yeah, of course I'd love more money. That would make things a lot easier. But I've got my fun money that I'm picking stocks with Ben, or putting extra, putting more money into Bitcoin, or I just bought a property which was a decent amount of money, or I have the boring stuff set and I forget. And then anything else, if it went to zero, I'd be bummed, but I'm not like, I can't afford my expenses, basically.
Yeah.
Balance.
Yeah. You never want to end up on a Reddit thread as the guy who like lost his life savings.
Yeah, exactly.
Options.
And I guess that's where I am, that I can be boring and I enjoy it. And then I'm also the exciting of like, the extra money I'm putting into Bitcoin, or the extra money I bought a house, or, whatever it may be. So I appreciate your story. So I guess my question that I love to ask is, what's your favorite book, podcast, website, YouTube channel? It doesn't have to be all of them. Some people like to be like, oh, this is my favorite one of each. It's just gonna be, what's your favorite go-to for investing or business or whatever you like to look at. And it can be anything you want.
Yeah. I give book recommendations to like when people want to learn about like financial planning. People like inside baseball books, like people want to learn about financial planning, good financial planning. Mitch Anthony, anything by that guy, or Carl Richards.
Okay.
Behavior Gap by Carl Richards is one. If you don't have already, you need to put it on your shelf. Like Carl Richards' Behavior Gap is a great book. Mitch Anthony, Your Clients for Life is a great book. I had an ethics professor in college one time. He studied behavioral economics. So I'm sorry, he was a psychologist who did ethics, but he taught behavioral economics as well in some quasi sense. And he gave us as a required reading a book called Thinking Fast and Slow by Daniel Kahneman. And
It's a great book.
That's, I think, my gold standard. Like if like you're going to read one book before you die kind of thing, like I think Daniel Kahneman's Thinking Fast and Slow is a good one. But to be honest, I like to read a lot of novels and fiction. I think your job, especially doing this podcast, my job doing financial planning is it's done best when you know how to tell a story, right? So like, listening to clients is important. Telling stories, telling analogies is important. So I read a lot of novels inside. Like I went through a Stephen King binge recently, and I think it's important to not get into an echo chamber. Like people who get so fixated on wanting to learn about investments, they just read like a litany of investment books, and that's fine. There's nothing wrong with that. I do the same with financial planning. You kind of get in these like binge modes, if you will, of studying one thing. But I personally alternate. Like I try and read like an autobiography or a novel, something like that, and then a business book. So I try and like alternate between the two to kind of keep myself sane and a healthy balance. So I don't know. I think you can learn from a lot of different ways. So I think reading people other than Kahneman, Carl Richards, Mitch Anthony, those guys, I would strongly encourage you guys to read with people you disagree with.
Mm-hmm.
Read with people who, if you're passive, are very active investors, right? If you're a Vanguard Bogle guy, read something from like a Peter Lynch, right? Who, an active investor there, or intelligent investor, kind of Benjamin Graham stuff. Like read people on both sides. And I think that applies to not investing, but life as well. So if you're extremely left or extremely right, I think it's the best way to learn is to kind of have a constant equilibrium between reading people you agree with and disagree with. And more often than not, I think we find ourselves somewhere in the middle.
I really like that tidbit. I'm going to try to do that when I am reading something that's like nonfiction and finance, because you really do get into that echo chamber, that like confirmation bias where you're like, okay, let me find every source where I'm right. I do the same thing when I'm like researching Bitcoin when I'm looking at stocks.
Just to be honest, I was talking to Jim, you talked about Jim Kreider. He's a friend of mine. And we were talking the other day and I texted him, I said, I want to find a book or an article, and maybe you guys have this and could share it with me after the show. Like, I want to find someone who's bullish on Bitcoin to the nine. Like they got a bunch of Bitcoin in their portfolio. And I want to find an honest critique of why it's a terrible investment. Like someone who owns Bitcoin and says, here are the X reasons why it absolutely could crash. Call it Fed manipulation or Fed regulation or all these different things, like decentralized or centralized. Like someone who's inside, like who obviously is bullish on it because they own it, but also willing to admit, hey, here's why I could be wrong. And the problem with certain asset classes like Bitcoin, or people who are big into precious metals, or real estate and Bitcoin, there's a lot of overlap of people who are like all about the, bigger pockets, fire, like real estate investors, like that's the only way to invest. And then you get people in Bitcoin there, this is the only way to invest. And the reality is there's a lot of ways to invest, right? Like,
and the funny thing is they both have track records of people making a lot of money in both. Like, it's not to say one way is right or wrong. Like, I know people that are multi-billionaires with real estate. I know people that are multi-millionaires and potentially soon to be billionaires with Bitcoin. Like, there's all different, like you said, there's all different flavors. There's chocolate and vanilla, and it doesn't have to be good or bad. And there's Rocky Road and mint chocolate chip. They're also good flavors.
Or you could get a salad.
Exactly.
Reading people you disagree with is just a good practice, and honestly, it gives you a posture of humility, because you never know as much as you think you know. But then also sprinkle in some Harry Potter when you can, I guess, just to keep
that is also something that really resonated with me, because to be quite honest, I feel like I do love to read informationally, like for fun, but I would say the bulk of my reading is fiction, actually. I just feel that if you don't tap in to the creative side of your mind, it's either left or right. I'm not a neurologist, but I think it's the right side of your brain is the creative side.
We'll call it the right side.
If you don't activate that muscle, it is so easy to sort of get into the complacency, being mundane, thinking about fact driven. You have this job deadline. You have to get X returns in your portfolio. Well, go paint a sunset. I mean, that's something that numbers really can't put on the page. And exercising that part of your mind is so important. It gives you a mindset that wouldn't have existed otherwise. Even playing video games, I'm trying to write my own.
Just finding a creative outlet, I think, is so important. Like, I mean, Gladwell, some people are for and against Malcolm Gladwell. One thing I think Gladwell does a great job at is he finds these weird, completely like random sequences or events, and he somehow finds like a common thread between them. And I think good advisors need to be able, and good investment professionals need to be able to learn how to pull on different strands and sources of knowledge. And if you only know markets, but you don't understand people, or let's say I'll give you a perfect example. The firm I worked at before, we had a guy who was a hedge fund manager in China. I mean, he knew the ins and outs of the Chinese markets, but the most valuable thing he understood was people. He lived in China for years. He understood the culture, and he understood the nuances of like what certain things could do. And so having that little context, it's a difference maker. It really is. And so, because I mean, when you invest in the stock market, what you're investing in is companies, right? Which are employed by people. And so, you need to be able to understand like human behavior and things like that. So reading books outside of just traditional investments can, I think, really benefit your investment background as well, for sure.
Yeah. And I think going back to your last point about, defending the opposite, I think it was Charlie Munger. I don't want to be wrong, but I think when he was in law school or he was in school, he was in a debate class. And if like you had to defend the opposite take of what you had. So, if you were pro this company or stock, you'd have to give 3 reasons why it's a bad investment or whatever it may be. And I know that's something they practice, I think at Yale Law School or even the law schools now. Like if you're gonna defend it, you have to also be the prosecutor or vice versa. And that's your way that you also learn, what your weaknesses are or what's good or what's bad about whatever you're going into or whatever it may be.
I think it's a great strategy. The firm I was at before, and I know we got to go here in a little bit, but the firm I was at before, we would meet once or twice a year, and they'd say, how can people beat us? And so they had an operations team, they had HR, they had finance, they had investments, they had client relations, like there's marketing, all these different sub departments. And they would ask the same question: how could you beat us as a company if you were a competitor in your specialized department? Like, how could you be better at marketing? How are other investment companies marketing better than us? How are they doing operations more efficiently than us? How are they? And so you have that introspection of like, okay, like not always being, self-deprecating and critical, but like realize like, you can always be working on something, right? And so there's some nuance there and some balance there. But I think reading people you disagree with, especially around Thanksgiving when it comes to politics, it might make for a better dinner, like at least that's my opinion.
Yeah, it's a great point. I know it's a little bit philosophical, but to your point about just like being present and like quieting your mind, like if you're so focused and your tunnel vision on sort of one mindset, you might miss the next big thing that's around you. And talking about Peter Lynch, he said that he just carries around a little notebook, and anything he sees, he finds out if it's a if it's a publicly traded company. And he's had some like multi tens of thousands % returns on like the stocking. Like I think it was, I don't know if it was L'Oreal, but his wife brought up something about stockings, and he was like, oh, maybe it's a publicly traded company, bought it 20,000% return that year. So you always need to keep your mind open and just be willing to accept ideas as they come in, and just like have fun. I think it's a lot more fun to read Harry Potter or to read about space if that's what you're interested in. Just there's everything is very, very interconnected. And you see it in business. Elon Musk says something or makes a tweet and it drives all markets all crazy. Everything is connected, whether you like it or not, in the age of the internet. And learning something about everything is a good strategy to implement. So I like that.
It'll keep you busy.
It will. So Jim, once again, thank you so much for coming on the show. Before we let you go, I'd love to give you the handoff. If someone wants to learn a little bit more about you or about your firm, where would you send them?
Yeah, absolutely. Feel free to shoot me an email. I'm sure you'll put my contact information in the show notes and things like that.
Sure.
Shoot me an email, give me a call. If you do have questions about your financial plan or about financial planning as a career path, or you're looking at a financial planner, I mean, obviously I'd love to help you and work with you. I have just as it could, I guess, be career damaging to a certain degree. I have just as much fun if a client's not a good fit for me, because I kind of have a niche of clients I like to work with. I have just as much fun finding them a good financial planner who does align with them. So if you're looking for a financial planner, and it may not be me, and that's totally fine, but you are looking for something along the same vein of what we talked about today, I'd love for us to get connected. And if it's not me, I'd love to connect you with someone who does good quality financial planning for their clients. And I have no problem and hesitation doing that whatsoever.
That's fantastic. I appreciate it, Jim.
Thanks, guys.
Thanks, Jim, so much. As always, smash the like button on YouTube. Give us a rating or review on podcasts. Find us on all social media platforms, or you can check out our website. So thanks, guys. Catch you later. Have a good one.